For the past 2 years, the global electric vehicle market has been defined by tension, trade disputes, tariff battles, subsidy wars, industrial competition between Washington, Brussels, and Beijing. But now, something unexpected has happened. Canada, one of the United States' closest economic and political allies, has announced a new electric vehicle strategy that includes expanded access for Chinese-made EVs. Under a newly announced strategic partnership, Canada will allow 49,000 Chinese-made EVs annually into its market at a most favored nation tariff rate of 6.1%. That quota will gradually rise to around 70,000 vehicles within 5 years. And here's the most surprising part. A recent Ledger poll shows 61% of Canadians support the move. This is not a minor policy tweak, it's a strategic recalibration in the global EV race. The announcement includes 3 key pillars. 1. Relaunch of EV purchase incentives. 2. A new EV cooperation agreement with China. 3. A $2.3 billion Canadian dollar affordability program. Let's unpack that. The affordability program, worth approximately $1.68 billion USD over 5 years, will offer incentives of up to 5,000 Canadian dollars per battery electric vehicle. At the same time, Canada plans substantial investment into expanding charging infrastructure nationwide. The goal is clear: accelerate EV adoption while building domestic capacity. But the China agreement is what changes the geopolitical equation. China is currently the world's largest EV manufacturer. It dominates global battery production. It leads in supply chain scale. It produces lower-cost electric vehicles than most Western competitors. Many Western governments have responded with higher tariffs, anti-subsidy investigations, industrial reshoring programs. Canada, however, appears to be choosing engagement alongside domestic development. Prime Minister Mark Carney described the quota system as a return to levels prior to recent trade frictions, but under an agreement that promises much more for Canadians. That phrasing signals 2 things. 1. A de-escalation of trade tension. 2. A structured approach to industrial partnership. Electric vehicles remain more expensive upfront than traditional gasoline vehicles. Even with falling battery costs, affordability remains a barrier. Allowing lower-cost Chinese EV imports could increase consumer adoption, accelerate emissions reduction targets, expand competition, pressure domestic manufacturers to innovate. At the same time, the strategy emphasizes using trade agreements to attract large-scale EV investment, diversify export markets, position Canada as a global EV manufacturing leader. In other words, Canada is not simply importing vehicles. It is attempting to integrate into global EV supply chains more strategically. This policy does not exist in isolation. Canada's largest trading partner is the United States. The U.S. has taken a more restrictive stance toward Chinese EV imports. If Canada expands Chinese EV market access while maintaining deep U.S. automotive integration, it creates potential friction. Will vehicles assembled in Canada using Chinese components qualify under North American trade rules? Will Washington view this as diversification or circumvention? Those questions remain open. The Ledger poll indicates majority support among Canadians, despite concerns. Why? Several likely factors. 1. Affordability pressure, inflation, and cost of living concerns make cheaper EV options attractive. 2. Climate commitments. Canada has aggressive emissions targets. 3. Consumer pragmatism. Voters often prioritize price and practicality over geopolitics. In democracies, policy durability depends on public backing. A 61% support level provides political cover. Canada already plays a critical role in the EV supply chain. Major reserves of lithium, nickel, cobalt, and graphite. Growing battery manufacturing capacity. Strategic proximity to the U.S. auto market. By pairing domestic mineral strength with expanded EV imports and cooperation agreements, Canada may be attempting a hybrid model: compete in upstream resources, collaborate in downstream manufacturing. This is neither full decoupling nor full dependence. It is selective integration. There are two competing narratives. Narrative 1. Risk. Increased reliance on Chinese EV imports could weaken domestic manufacturers. Geopolitical tensions could disrupt supply chains. Policy misalignment with the U.S. could create friction. Narrative 2. Opportunity. Lower-cost EVs accelerate electrification. Cooperation attracts foreign investment. Diversified trade reduces vulnerability. Canada positions itself as a neutral bridge in a fragmented EV world. Which narrative prevails depends on execution. The electric vehicle market has become a proxy battlefield for battery dominance, rare earth access, green industrial policy, trade protectionism. China leads in cost and scale. The U.S. leads in innovation subsidies. Europe struggles with competitiveness. Canada is now attempting a middle path. If successful, this strategy could make Canada a North American EV manufacturing hub, a resource powerhouse, a diplomatic bridge between major EV blocs. If unsuccessful, it risks supply chain entanglement without domestic scale. 49,000 vehicles annually, rising to 70,000. 6.1% tariff rate. 2.3 billion Canadian dollars in incentives. 61% public support. These numbers tell a story of recalibration. Canada is not rejecting its Western partnerships. It is adjusting to a multipolar EV market. In the 20th century, oil defined energy geopolitics. In the 21st century, batteries may define industrial power. Canada has decided not to sit on the sidelines. It is entering the EV race with a strategy that blends cooperation and competition. Whether that makes it a leader or a battleground remains to be seen. If you found this breakdown valuable and want more deep dives into global EV strategy, green industrial policy, and geopolitical trade shifts, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss the next analysis. And tell me in the comments, is Canada making a smart strategic pivot or taking a geopolitical gamble? Let's discuss.